Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, March 6th. The markets swing on hectic tariff news. Growth expectations on both sides of the Atlantic Ocean become the major driver of market prices. The Stoxx 600 index is set to outperform the US peers by most in a decade as MAGA, Make America Great Again, is now losing traction among investors against MEGA, Make Europe Great Again. So following news is becoming a pain, I must admit. News that are related to Donald Trump and his decisions go just too fast. They are too hectic, they are too volatile, they are too inconsistent, and all this is too much for a country that has such an important, a significant global influence. Jeez, but we do our best, so yes. Donald Trump said yesterday that the tariffs that concern the North American car industry will finally be delayed by a month. And the decision came just a day after, he imposed 25% levies on all Mexican and Canadian imports. I mean, who lets this happen? Seriously, it's becoming just so weird. It has become a game, really. The problem is tens of companies here and thousands of jobs are now concerned by these hectic and uncertain decisions, and no one really knows if these decisions are serious and how serious they are. Even Trump's own team doesn't know. So global markets share the idea that Donald Trump actually turning threat into reality and, rolling it back was cool. Probably cooler than going ahead with 25% tariffs and maintaining them in place for the next 4 years, but the uncertainty and the lack of seriousness and consistency of these decisions will certainly have a negative impact on US growth. I don't see how it's possible otherwise. How could you just decide today to go ahead and invest in the US if you have no idea whatsoever about what tomorrow is made of, right? All this is to say that tariff or not, the way things are going right now are looking bad for the US economic growth. Now, in the market space, the car stocks actually rebounded at yesterday's trading session on hope that maybe, but just maybe, there will be a magic agreement within the next 4 weeks to prevent these 25% tariffs from becoming the new reality of the car industry in North America. The Mexican and Canadian investors were somehow relieved. Mood in Europe was significantly better as well. The Stoxx 600 index actually recovered 0.91% yesterday, while the DAX index jumped 3.38%. Even though the tariffs haven't reached the European coast of the Atlantic Ocean just yet, the European investors are obviously extremely sensitive to the trade news, and that leads to big size moves in the market, rising the market volatility. So the market conditions are getting very appetizing for traders who are actually looking for interesting short-term opportunities. But if you're looking at a broader market sentiment, jumps of, 3% that are then followed by a sell-off of the same size the next day and then a rebound of a similar dimension the day after are not necessarily great for the market mood in the medium to long run. And it is very important at this point to have a clear playbook and determine carefully what influences the market moves today, what influences them the most to prevent losing your way in this jungle. Is it the economic data? Is it the central bank expectations and the central bank decisions? Is it politics? Is it geopolitics? What is it that influences the market moves the most today? Over the past 2 years, for example, since the beginning of 2023, the main trading themes in the West especially were AI and the central bank decisions. Before that, it was COVID. The market prices were very sensitive, remember, to these factors. Now, looking at the economic data over the past 2 years, especially over the past year, the incoming data was digested in the context of the impact that it would have on the central bank decisions. As such, I'm giving an example. Weak economic data especially weak inflation data last year in the context of rate cuts was perceived as being good news by investors, as weakness would lead to lower interest rates, and lower interest rates would boost economic growth and the company valuations. Today, it is different. Today, we are actually shifting from that to looking at growth expectations very closely, both in the US and elsewhere, while the importance of the inflation outlook is no longer the same for all markets. For the Federal Reserve expectations, for example, the inflation outlook is crucial today because the tariffs, the huge tariffs, are expected to have a direct impact of boosting the US inflation, and that would limit the Fed's ability to cut the interest rates to boost growth in America. In this scenario, obviously, the weak economic data is bad news for the market sentiment. In Europe, however, the situation is different. The inflation outlook is still very much important, but growth outlook has become more important because, simply because the European countries are today obliged to boost their military budgets, no matter how fast inflation is growing, indeed, simply because they have no choice. They have to ensure their security. And this no choice situation is very much reflected in the way Germany is acting today. This is the first time our generation sees Germany acting this way. The country is literally throwing the spending speed bumps out of the window to allow boosting their spending in defense and in security. And it is understandable. And they now want to create a 500 billion euro infrastructure fund to get the continent back to its feet in terms of security and military needs. We are slowly getting toward Draghi's $100 billion worth of European fund to boost technology and security investments. Remember that, and generate growth in Europe. So we are getting there, and the cherry on top of all this, where Germany's Friedrich Merz, said that he will do whatever it takes to strengthen the continent's defense capacity. So that's Mario Draghi's signature phrase. Remember that one? Whatever it takes. So if it takes higher inflation, it will take higher inflation to get Europe rolling again, folks. In short, US growth expectations remain closely linked to inflation and Fed policy, while European growth forecasts are getting a lift from higher spending prospects, especially in the military and security, and become less dependent on the European Central Bank's monetary decisions. This is perhaps why the 30 basis points jump in German 10-year yield and the higher than expected PPI data yesterday released in the Eurozone didn't prevent the German DAX index from gaining more than 3%. The Stoxx 600 index is set for its biggest quarterly outperformance against the S&P 500 in a decade, and the euro-dollar recorded its best 3-day session in a decade as well. The European Central Bank is expected to cut its interest rates by 25 basis points when it meets today. Then the presser from Christine Lagarde will be as interesting as it will be the first time the ECB chief, Christine Lagarde, will be talking since the US decided to withdraw its military support to Europe. And because I'm here and I'm watching the markets every single day, I find it quite safe at this point to say that the military decision of the US marked an important tipping point in sentiment overall and in what matters for the Europeans. So let's see what Christine Lagarde says about all that. But overall, the waning US growth expectations versus rising European growth expectations favor the European assets and the euro at this point in time. Across the Atlantic Ocean, the major US indices were better bid yesterday as well. The S&P 500 gained 1.12%, the Dow Jones added 1.14%, and the Nasdaq 100 rebounded by 1.46%. But uncertainties rule. The tariff talks, actions, decision reversals, and all that craziness make the US markets a riskier place to be today. On the data front, the ADP report showed that the US economy added around 77,000 new, private jobs last month. That's almost half of the number that was expected by analysts, mind you. This growing number of job cuts at companies, including federal contractors, the policy uncertainty, and also the slowdown in consumer spending as a result of it explain the weakness in yesterday's number. Happily, the ISM data came in better than expected in the US to prevent a further sell-off of the S&P 500 below the 200-day moving average psychological mark, but I think that's just a matter of time before we see index return below that level. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.